Let me ask you something. How many times have you gone back and forth between two stocks, overthinking choice, finally pick one, and moves like turtle? It crawled up 3% over 10 days. Meanwhile, the stock you didn't choose launches like a rocket, hitting new highs in just 2 days. And you are left staring at the chart, thinking, seriously, why was I in that trade? Painful, right? Of course it is. You caught the trend, you got the direction right, but you still missed the big move. If this keeps happening, it is not because you are unlucky. It is because you are missing the real force that drives a stock's trend: momentum. Trend shows you the profit opportunity. Momentum determines how fast it can play out. So today, along with me, Oasis, assistant coach to two-time investment champion JLaw, and my assistant Chimpanzee, we're going to walk you through the secret weapon behind powerful gains: momentum. In the previous lesson, we explained that every price movement comes from a tug of war between buyers and sellers. A trend forms when one side finally takes control and the money continues to flow in or out. But not all trends has the same strength. Sometimes one side wins so quickly and so forcefully the money rushes in or out aggressively in a short period. This surge creates momentum, which will push the stock to suddenly move much more powerfully. Take JDN SNDK as example. From August to November of this year, the exact same 3 month period, both stocks were trending. But GD, without momentum, climbed just 16%. SNDK, with momentum, skyrocketed 610%. In trading, we can put it this way: trend tells you the direction, up, down, or sideways. Momentum is the force behind that direction, how fast it moves, how strong it is, and how much push the market has. If there's a trend but no momentum, the trend won't be strong and last long. If there's a momentum but no trend, the price gets messy and you cannot find any good entry or exit signals. We want direction, and we want the direction to have power. So that is why the first edge of JLaw's multiple edge trading strategy is it's not just trend. And it's not just momentum, it is the combination of trend and momentum working together. So the next question is, where does momentum come from? What makes a stock suddenly speed up? In most cases, strong momentum comes from a catalyst. Something that suddenly changes what people expect from a company, something that makes the market say, wait, this company is now better or worse than we thought. Here are some key catalysts: big earning beat or terrible earning miss, analyst upgrades or downgrades, new product launches, technology breakthroughs, major partnerships or acquisitions, leadership changes, and more. Beyond company-specific news, things like government policy changes, industry cycles, and shifts in overall market demand can also generate momentum. All of these catalysts can create a new story in the market, sparking excitement or disappointment, driving momentum. Here's some real examples. XMTR reported strong earnings on August 5th, and the stock jumped 50% in one single day, and climbed 80% over the next 38 trading days. On October 6, AMD announced a partnership with OpenAI. The stock instantly popped more than 30% in one day and gained 56% within 17 trading days. MU, a leading memory chip manufacturing company for AI and data center applications, jumped more than 100% in just 46 trading days, fueled by soaring demand of the AI industry. From those cases, we can see that momentum will not last forever. Earlier buyers will take profits, excitement will cool down, price will drift back toward the fundamentals, and money will rotate into new stories. Once this process begins, no matter how strong the move was, momentum fades. But usually, how long does momentum last? It depends on the strength of catalyst behind it. Short-term momentum, for example, the kind triggered by quick news, tends to last from few days to few weeks. Mid-level momentum, for example, the kind driven by earnings, new products, or technology breakthroughs, can last from few weeks to few months. Large-scale momentum, for example, the kind sparked by fundamental shifts or big industry trends, can last for months or even longer. Just to get examples were mentioned. AMD's rally came from the news and lasted about 17 trading days. XMTR's momentum was driven by its earning report and continued for 38 trading days. MU benefits from the rise of the entire whole sector, giving large-scale momentum that lasts more than 2 months. And once momentum ends, a stock typically moves into consolidation or starts to decline. And only when new catalyst arrives, something strong enough to reset market expectations, does the next wave of momentum begin. So, momentum always comes in phases. I want to emphasize the importance of momentum's duration because once you accept that momentum is temporary, we'll understand why putting all our capital in one single stock for a long time is not a good idea. Pro traders jump in when momentum is strong, step out when it starts to fade, and rotate their capital into next stock starting a new momentum wave. This keeps their money working efficiently and allows profits to compound faster. One thing we notice about momentum is this. Sometimes a stock has no visible catalyst, but it suddenly surges or drops sharply. And when this happens, the market may be reacting to information that hasn't been made public. Often, the stock is simply a strong or weak name showing relative strength or relative weakness long before the majority notices. During the market pullbacks, strong stocks may also dip with the market, but they hold up better. And once conditions stabilized, they're usually the first to attract capital again. And that is when the momentum kicks in. Weak names behave the same way, just in the opposite direction. Because their fundamentals are shaky or the charts are badly damaged, once market sentiment turns negative, they tend to fall faster and harder, creating strong downtrend momentum. A good example is PLTR. During the sharp market decline in April caused by tariff policy concerns, PLTR, one of the strongest names at the time, pulled back but held up far better than the market. Investors and traders recognize their relative strength, so once the market is steady, PLTR rebounds quickly and produces a strong upside momentum. There's another reason momentum can appear without news. Institutional investors often get some key information before it becomes public. They quietly position early, creating momentum. As individual traders, we have to accept one truth: we will always be at an information disadvantage. Sometimes we never learn the real reason behind the move. Sometimes, even after the news comes out, we still cannot confirm it with the true cause. But price action doesn't lie. The chart reflects real capital flow with no delay, no filter, and no interpretation. In many cases, the information shown on the chart is more accurate, more timely, and more honest than the news itself. This is why JLaw always emphasizes just trade what you see. He also teaches that when the chart shows a valid momentum structure and a reasonable entry point, we could trade first, then investigate later. But to do that, you must know how to find momentum from the chart. To see what momentum actually looks like on the chart, we can compare a normal trend with a trend powered by strong momentum. Let's do a quick exercise. I will pause the screen for 5 seconds so you can try finding the differences yourself. Did you catch them? You can find that both charts are making higher highs and higher lows, but if you look more closely, the details are very different. On the left, throughout the trend, green candles far outnumber red ones. And once the trend starts with strong bullish candles, more green candles follow in the next few days. and this creates a typical follow-through structure, a clear sign of aggressive buying pressure. You'll also notice that when one bullish candle pushes into the next, the bodies barely overlap. Sometimes you will even see gap-up candles. A gap-up means buyers are so eager that they're willing to push prices sharply higher right at the open, and sometimes even before the market opens. That's a clear sign of a strong demand and urgency. If these gaps don't get filled, means buyers refuse to let the price fall. That shows strong conviction in the trend. Now let's look at the volume. In a strong momentum trend, candlestick structure usually lines up with volume. Large bullish candles often come with heavy volume. That is something retail traders cannot create because only institutions have the buying power to push volume like that. So big volume is often clear footprint of institutional demand. You'll also notice that during the advance, volume is high, and during pullbacks, volume shrinks. When the stocks start climbing again, volume spikes once more. The contrast between big volumes on rallies and small volumes on pullbacks is obvious. This tells that buyers want to push the stock higher, while sellers are not willing to dump shares on dips. The pullbacks are not sell-offs, and they don't break the trend. Now, let's look at the moving averages, especially the short-term ones, the 20-day and 10-day MA. When these MAs are stacked upward, it shows the market is in clear short-term momentum. And in a strong trend, price typically finds support as soon as it pulls back to the 20-day MA. Sometimes it doesn't even get that far. It bounces up the 10-day or even the 5-day MA. The less the stock wants to pull back, the stronger its momentum. Now let's look at the normal uptrend, and you can soon feel the difference. In a normal uptrend, you don't see many strong bullish candles, and even when a bullish candle appears, there's often no follow-through, as the next candle might turn bearish. Gaps up are rare, and when they do happen, they usually get filled quickly. You'll also notice that bullish and bearish candles appear in similar amount, with neither side showing clear dominance. Volume reflects the same story. Rallies come with modest volume, and there's not much contrast between volume on advances and pullbacks. Prices often pull back to the 10-day, 20-day, or even 50-day moving average. Now let's examine the opposite case. A normal downtrend and a strong downtrend both show lower lows and lower highs, but again, the details are very different. In a strong downtrend, the same signal we just talked about appear, but in reverse. You will see big bearish candles with far more red candles than green ones. Drops show clear follow-through. One bearish candle push the next with little or no overlap. Sometimes you will find gap-down candles, big volume on the way down and tiny volume on the way up. The contrast is really obvious. And when the 20-day, 10-day, and even 5-day MA are all sloping downward, bearish momentum is clearly in control. Price often get rejected at 20-day moving average. And in very strong trend, even the 10-day or 5-day acts as resistance. However, in the normal downtrend, nothing on the chart really stands out. No strong bearish candlesticks, no heavy volume, and the price often crosses 20-day MA or drifts back to the 50-day MA easily. Nothing can leave a strong impression. Now you might feel a little bit bored thinking, do we really need to read charts that closely? Are those details really that important? Answer is yes. In real trading, it is often small, easily overlooked details that decide whether you become consistently profitable or continue to lose money. Here, I want to quote a line from a classical trading book named Trading the Zone by Mark Douglas, the father of trading psychology. When he talks about how humans form perception, he says, there are many ways in which external environment can express itself that we don't perceive, simply because we haven't learned about them yet. What does this sentence mean? Imagine these two situations. If you have never learned to read sheet music, the stuff below just looks like a bunch of strange symbols. but the classical musician can soon recognize it as Beethoven's Moonlight Sonata. If you don't understand Japanese, this sentence looks like a string of random characters, but someone who knows this language can instantly see that says, I love you. The information is the same, but because our knowledge differs, our perception differs, and we end up living totally different versions of the world. In the book, Mark Douglas explained why this concept is so important for traders. He said that when someone who has never studied technical analysis looks at stock chart for the first time, it's just messy lines, it's just some undifferentiated information. But once you understand the meaning and the use of candlesticks, moving averages, parallel channels, trend lines, the relative strengths, and more, then look at the same chart again, suddenly you can see things you cannot see before. Just like the footprints of buyers and sellers, the emotional swings of market participants, the risks and opportunities hidden inside the pattern, and more. The chart doesn't change, but you change, and when you change, the world you see changes. This is exactly what market says. We don't see the world as it is. We see the part of the world we've learned to recognize. So, unless we operate with genuine openness, we will only see what we want to see. To become a winning trader, we need to stay open-minded, keep learning, and train our chart reading to be detailed, precise, and professional. Only then can we see what the market is actually doing, not just the part we want to see, and not just the part our limited knowledge allows us to see. That's exactly why investment champion JLaw officially launched the JLawStock Academy. His goal is simple: to develop traders and investors with true professional capability. JLawStock Academy is continuously evolving, up-to-date trading program led by the JLaw coaching team. No matter where you are starting from, the program provides a clear structure path from the fundamentals to professional level skills. And throughout the journey, the team is here to guide and support you every step of the way. If you're ready to level up, click the link in the description and take the step from participant to professional. Alright, now you know how to spot stocks with trend and momentum. So the next question is, how exactly should we enter trade? Where do we pull the trigger? Let's use META as example. When we get the chart, the first question we ask is, has a trend formed? On November 30th, a large bullish candle appeared on the chart. This big green candle broke above the previous highs and was supported by strong volume. In the following days, price volatility tightened. Candles became smaller and more compact until a high-volume gap-up candle showed up, once again breaking the previous high. Since then, that gap has never been filled. And after that, the stock continued producing higher highs and higher lows, creating an uptrend structure. At the same time, the 10-day, 20-day, and 50-day MA all turned upward and began sloping higher. When you put all these signals together, it becomes clear a new uptrend forming. Now, let's ask the second question. Does this trend have momentum? Based on things we just learned, here's what we can see. For more than 1 month, there were far more green candles than red ones. We saw many non-bullish candles, and the candles kept pushing forward with very little overlap in their bodies. Gap-up candles appeared, and the gaps were never filled. The big bullish candles came with heavy volume, and every time the price pushed higher, volume spiked, and whenever it pulled back, volume dried up. The price also stayed above the 10-day MA for 1 month, and every time it touched the 10 MA, buyers stepped in immediately to support it. Then, on the second day of February, the price gapped up again and increased 30% in just 1 day. The relative strength line was climbing too. All of this information was telling us one thing: the momentum is really strong. And now, is it time to buy? The answer is no. Pro will slow down and ask, is this momentum appearing early in the trend or at the very end of it? A stock usually goes through a typical cycle. Bottom, uptrend begins, pushes higher, tops out, downtrend, bottoms again, and repeat the cycle. And during this cycle, you can often see strong momentum showing all the signals we just discussed at the end of the trend. That's when the market is the most hyped, social media is full of profit screenshots, news and analysts keep pumping out bullish stories. Everyone is talking about how strong the stock is. Retail traders rushing make the price action look insanely strong. But here's the catch. This is exactly when big players like to sell. While retail traders are thinking, momentum is crazy, I need to jump in now. Big players are thinking, perfect time to get out. They accumulate quietly at an early stage, so when a huge crowd of retail buyers are chasing the top, they get a perfect chance to unload the position at the best prices. And then what will happen? A big drop follows. This is why pro traders avoid late stage momentum. Let's look at META. After downtrend, it finally formed a clear bottom. Then it climbed, first leg up, a short consolidation, second leg up. The second leg shows strong momentum while still close to the bottom. This is the kind of momentum pros want to trade. Not the hype at the top, but the strength that appears early in the move, or not far from it. So, is it time to buy now? The answer is no. Remember what we talked about in the last video? After rounding up, early buyers tend to take profits. Especially when a stock moves up too quickly, it often triggers short-term traders to dump the positions, which leads to a pullback. You can see this clearly on the chart. Over the next week, the stock dropped 15%. If you had chased the price, then as soon as the stock pulled back to this area, you probably would have been stopped out. Now the question is, the stock just dropped and the two big red candles make the structure look a little bit ugly. Should we still keep an eye on it? Or do we need to take the stock off our watch list? Here's the key difference between pro traders and retail traders. Most retail traders see a pullback and panic. It's time to get out. But pros will stay calm and say, alright, let's analyze what's going on. Pros pay close attention to how the stock pulls back and what the pullback is telling them. From that information, they can figure out whether the drop is healthy and whether the pullback is damaging the trend or not. And when the pullback is healthy, pros see it as potential opportunity, not a reason to delete the stock from their watch list. Let's look back to META. We can see that the price was still holding above the 10 MA. And notice the volume. It expanded on the way up and contracted on the pullback. Clear evidence that buyers remain in control. So, this pullback didn't appear to breaking the trend, it looked healthy. To draw this conclusion, you also need to recognize what an unhealthy pullback looks like. Let's imagine, if the stock continues dropping on heavy volume, that shows increasing sell pressure. If it breaks below the 20 MA, that shows the momentum is mostly damaged. If it breaks below the low of this candle, that shows the stock has given back the entire strong move and sellers have taken over, and it's time to get out. But since the signals haven't appeared, we still choose to follow on this stock. Alright, next question. Can we just get in right here? The price is sitting on the 10 MA, right? Isn't it a support? In fact, you could enter near the 10 MA, but more experienced traders will choose to wait a bit longer because they understand two things that are frequently overlooked by others. First, the more a support to resistance level gets tested in a shorter period of time, the more likely it is to break. The price has already touched an MA 3 times in very short span. By the fourth test, the 10 MA is unlikely to hold as support. If you don't fully understand this yet, that's totally fine. Support and resistance is the second edge of JLaw's multiple edge trading system, and it's exactly what Oasis and Chimpanzee will cover in the next video. So be sure to subscribe to this channel and you will get updates the moment they drop. Second, we have known that after strong run-up, Early buyers begin taking profits, and the stock naturally shifts into consolidation. When a stock has been climbing non-stop for 2 months, it typically needs 2 to 4 weeks of consolidation to absorb profit taking. Now look at the chart. The stock went from 90 to almost 200, more than 120% move in just 60 trading days. There were two major lags in that move. After the first leg, the stock barely consolidated before blasting off into the second leg. And the second leg was faster and more explosive than the first one. So, in this area, the stock needs at least several weeks to digest both moves. A few days simply were not enough. We're not saying that you cannot buy around the 10 MA, but if you do, your capital may be stuck in the consolidation, go nowhere, or even show an immediate paper loss. Turning situations like this from a loss into a profit requires more advanced trading techniques, stop-loss strategies, and risk management skills. If you're interested in learning those techniques, leave your comments and I will be covering them in our future courses. Also, you can join JLawStock Academy to dive deeper. Back to this trade. Can you find a better entry point than buying at 10 MA? According to JLaw's multiple edge trading strategy, you can wait for the price to pull back on no volume into this green zone before entering the trade, because this area lines up with the previous swing high. If that swing high can hold up support, and the rising 20 MA comes up to form the second layer of support, buying this area gives you multiple layers of support, which means the lower chance of price breaking down. And also, a low volume health pullback means that the trend and momentum are still intact. Of course, we can never know whether the market will follow our plan, but if it does, they will just follow through with our execution. I want to walk you through this entire thought process step by step because I want you to clearly see how pros think before they enter trade. What you will notice is that pros make decisions using a simple, consistent if-then logic. If the price moves up and behaves in a certain way, then what is my plan? If the price pulls back and shows certain signs, then how do I react? Before taking a trade, pros thinking through questions like this, map out different scenarios and decide how they would respond to each one. Then they build a complete trading plan based on the rational answers. Although the market won't move as they expect, having a well-structured plan keeps them from trading impulsively. For example, buying just because they see a big green candle or selling just because they see a big red one. The decisions are supported by logic and rationale. To become a winning trader, you need to adopt this mindset. The market is uncertain, but your thinking should not be. Now let's go back to the chart and see what happened next. You will see that over the next 2 days, the stock only bounced a little and then quickly dropped again, this time breaking below the 10 MA. This basically confirmed what we said. It was too early to buy at 10 MA. Soon after, the stock pulled back into green zone we marked. And once it entered that zone, we could see that the previous swing high did act as support. One candle tried to dip below the swing high, but buyers stepped in and soon pushed it back up. The bodies of candles became super short. Multiple candle bodies overlapped, showing volatility was tightening. Volume dried up. And the lagging 20 MA finally caught up from below, adding another layer of support. Put all this together, and we can get a beautiful setup to end the trade. Here, I want to explain 3 key concepts that will show up again and again in our courses: setup, consolidation, and correction. First, consolidation. As we mentioned in the last video, this is when the price moves sideways, buyers and sellers are balanced, and the market hasn't formed a trend and picked the direction yet. Correction happens when the market is already trending and picks the direction, but the price pulls back a bit to digest the previous move. It is a dip doesn't break the trend. A setup is what traders look for. It is how you judge whether the current price action is giving you the possible entry opportunity. To sum up, consolidation and correction describe the market's behavior. They are objective description of what the market is doing. A setup is an entry strategy. It is subjective and describes what you might do. Let me use a metaphor to make this clearer. Consolidation means like the market standing on the platform, unsure whether to take the staircase going up or the one going down. Correction is like the market already on the staircase, but take a quick breather. The climb or the drop is still in progress. A setup is like you waiting the right moment to take your first step onto the staircase. I want to highlight the difference because we often see corrections, but not every correction is a good setup. For example, in this entire consolidation zone, technically both area A and area B can be considered as corrections. But for me, only B is the real setup, A is not. Why? Because in section A, the swing in both price and volume are still too large. But in section B, price and volume clearly tighten up, giving us a clear, healthy, and constructive setup. We can buy this bar, and this bar. And once we got in the trade around area B, the stock went up 10% in just 3 days. Within 13 trading days, it went up 22%. Now zoom out and look at Meta's other swings. You will notice that in our trade, the stock gained 22% in 30 days. But in the previous section, it gained 70% over 22 days. And here it gained 10%, but took 20 days. Same stock, same long bias, yet each swing delivered completely different speed, efficiency, and profit potential. That is the power of momentum. Some swings give you 10% in 3 days. Others need 3 months for the same return. If you can earn in 3 days while others earn in 3 months, that leaves you 2 months and 27 days to deploy your capital into the next high-efficient trade. For short-term traders, catch momentum, win, exit, and rolling the capital into next strong setup. Combining momentum with turnover rate is one of the best ways to grow account faster and compound returns. Our goal is not to trade every trending stock, not every swing within a stock. What we need are 2 skills. First, train our eyes to identify one stock among many with momentum behind this trend. Second, train our patience so we can wait and only enter when real momentum actually shows up. To sum up, spotting strong momentum begins with understanding how it actually appears on the chart, how the candles behave, how volume expands and contrasts, how the moving averages change, and how all these elements come together to form one structure. This page is important. Screenshot it, save it, and review it often. Once you're familiar with this structure, you won't feel lost when you open the chart. You will instantly see the full picture. You won't get distracted by a single candle and miss the larger setup. And you'll quickly pull ahead of others who still cannot see the forest for the trees. Trend and momentum are only the first edge in JLaw's multiple edge trading system. The next one, support and resistance, determines whether you can identify the key price levels that truly matter and can make huge difference in your win rate. See you in the next lesson.